Welcome to the Professional Investment Podcast, and we're just starting our third series. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome our first guest to the third series, Ian Connatty, Managing Partner at British Growth Partnership at the British Business Bank. That's quite a mouthful of a job title, Ian.
Thank you very much. Great to be here.
It's lovely to have you. Do tell us, what is your news story of the week?
So my news story of the week is this story from the FT, which was published on the 26th of April, which is UK entrepreneurs sound alarm over tariffs hit to small businesses. And I think it's really a great example of how really big news stories like the tariffs can't fail to have noticed that was taking place, really hits every single corner of the economy. It's quite easy on the news to see the impact on big companies and car exporters and steel manufacturers and so on. But actually, there's a real impact on smaller companies up and down the country. And the story talks about what some of those are.
Yeah, I think it's a great news story to choose for the week because it manages to marry that macro global economic effect with the micro, and we sometimes forget about that, don't we?
We certainly do, and I think from the perspective of a smaller company, there's much more at stake very often than there is for larger ones, and the story talks about how some of these businesses might have to stop trading in the US altogether. But there's a couple of kind of other interesting points to draw out from it. One is about confidence in general. So HSBC did a survey of small to larger companies of what the impact might be, and 66% of companies quoted in the article said there would be an impact of some kind, which might lend you to believe that actually there'll be 34% of companies that won't be impacted at all. But actually it goes on to talk about the impact on confidence and the kind of wider effects of that as well.
So let's talk a bit more about you right now, Ian, and what you do, because as I mentioned on the intro, it's a bit of a mouthful of a job title, Managing Partner at the British Growth Partnership of British Business Bank. So tell us, what is it you do at the British Business Bank?
So I'm currently spearheading the creation of something we're looking to establish called British Growth Partnership, which is something we're looking to do to catalyse greater institutional investment in the UK's higher potential, high growth companies. So a kind of startup within the broader bank, if you like. So I know your previous guest had 11 zeros under management. I'm currently just at zero, but working on it.
One can always have ambition for 11 zeros, even if it might take 11 lifetimes, right?
Indeed, yeah. And before I was asked to do this, I've been at the bank for about 16 years as a venture investor, so investing in funds and then more latterly directly into companies. So yeah, my heritage is venture capital.
So you are very much within the British Bank. We can think of you as a venture capital fund within the British Business Bank. Is that the way to think about you?
Once everything's set up and we're regulated and so on, yes.
Okay, good. But that is your background as well. Yeah,
that's my background as well. Yes, and before I was an investor, I worked in a startup as well. So I've seen startup land from different angles as well.
Okay, so you know the fun part of being a startup, as I'm kind of part of a startup with a 2-woman organization, which is basically every day is how not to drown in operational detail. I think that's pretty much the challenge of startups. So tell us a bit more then. We've heard a lot in recent months about how the government wants to encourage pension schemes and large institutional investors to invest in UK productive finance, of which venture capital is part of. Why is venture capital so important to our economy? What does it do that other bits of capital can't do?
Yeah, I mean, venture capital has always been important historically in terms of funding new ideas, new innovation, and help bringing those to market. I think what's different about now in particular, and has been probably for the last 20 or 30 years, is the nature of those new ideas is quite different from those that went before, in the sense that a lot of those new ideas are based on intellectual property, on intangible assets, and so it's far harder to fund that kind of innovation with bank debt. So venture capital becomes a really important mechanism through which you bring innovation through into the market. And in terms of how that impacts not just the economy but all of our lives, I was trying to explain to one of my children the other day the concept of Blockbuster Video, or sort of those kind of video stores that you used to go to. And of course, they've only ever known a world where you switch on the TV and it's all there for you. So having to try and explain rewinding a tape and not getting fined and all that kind of stuff, make actually how much the world does change. So from an investor point of view, what venture capital does is it helps to build exposure to that future economy that will one day actually be the mainstream economy. And particularly if you're investing over a long time horizon, which is, I know, something Veronica mentioned on your show when she was on, actually, if you're the kind of investor that can afford to think over 20, 30, 40 years, the world will change quite a bit in that time. And venture is a sort of on-ramp to that kind of innovation.
Yeah, so, and talk to us about where venture capital sits in that kind of the capital stream, if you think about it. Before venture becomes angel investment, doesn't it? And then you have venture, and then do we move then into private equity and then either stick with private equity or into the public market? Are there some glitchy bits around? Where does the glitch happen? Because we do have quite a well-developed venture capital market in the UK, obviously nothing like the US. But what is it maybe that the US does better than what we do? Where are the roadblocks?
Yeah, I mean, to start in terms of how it works, I mean, that there's what's classically called the ladder of finance, although, as you kind of hint, it's a bit murkier than that in real life. And a colleague of mine likes to call it the larder of finance. You can sort of pick and choose the finance that's more relevant for you. But in a kind of typical journey, it's friends and family or angels at that very early stage, and then venture capitalists. And those venture capitalists tend to get then bigger in size as the company grows. So companies go from raising a few 100,000 to a few million to tens of millions to hundreds of millions as they kind of grow and scale. And in terms of how the UK compares, actually, we're pretty good at starting companies, and even before that, the kind of innovation that you need to draw on to even start a company in the first place, we're also pretty good at that. Our universities are world class. So getting things going is something we seem to be pretty good at. It's what comes after that where we're already pretty good, but there's room for improvement. In fact, the UK is the third largest market globally for VC. So VC is something we're already pretty good at in the UK, although we sometimes forget that. But yeah, it's this scale up piece. So we're good at starting, but where we need to improve is how you scale up. And in terms of the data on that, when the bank, as we're an economic development bank, we do lots of research into this kind of thing. What we found was that as companies grow and scale in the UK, compared to an equivalent cohort in the US company is raising on average about twice as much money as they grow and scale. So that means those companies are able to fund growth more quickly than their UK counterparts. So if we can help to narrow that funding gap, and not necessarily fund more companies, but fund more companies to a better extent than we currently do, that will allow us to kind of drive forward in our venture capital ecosystem.
So as I mentioned, the problem with any startup is not to drown in operational sort of detail every day, because you don't have enough people to do it. But also, I can see that if you actually need £50,000, but you can only raise £25,000, just as an example, and then you have to do 2 rounds of fundraising, which again depletes your time, because then you're having to run around finding investors to find the capital rather than actually just growing the business. I can see that can constrain your growth and reduce increase your chance of failure as well, because you might not get that second round, or you might just be too distracted by funding to be able to do what you're supposed to do.
Yeah, and the other thing as well it might do is lower your ambition levels. If you genuinely don't think that that capital will be there, you cut your cloth accordingly. So perhaps you don't aspire to grow as fast as you otherwise would, or enter that new market, or whatever the case might be. So it's one of those odd markets. There's a little bit of supply creating its own demand. In other words, that the fact that capital is there generates the demand for the capital because it fuels that kind of ambition. So for us, it's about, there are plenty of reasons that companies of that size and scale don't make it, but our ambition is to try and make it the case that that's not for want of capital, right? So that's not necessarily a reason that they don't make it.
Give them the best possible chance.
Absolutely, exactly.
So to go back to our news story of the week, where we talked about the geopolitical impact on individual economies and even small companies within individual economies. Maybe one of the things we can do with the British Business Bank, because obviously we are funding growth in the UK, is that we can maybe sort of try and mitigate some of that geopolitical risk by focusing on our local economy.
Yeah.
But we also have to take into account that companies are only going to do as well as the overall health of domestic economy. Of course, there are always going to be winners and losers in any situation. But if you have more economic growth, you're going to have more winners than you are going to have losers. So how do investors balance that? On the one hand, you can insulate yourself from geopolitical risk, but on the other hand, you are then have very concentrated risk to one domestic economy. How do you think about those kind of risks when you're investing?
Yeah, and I think there's very different flavors of small business. There's small businesses which absolutely are beholden to the local economy. If you think about, car repairs or things like that, actually how much money there is and demand locally really does make a difference to those businesses. Still not insulated from our story of the week, of course, because, if I go back to my car repair business, you've got to buy tires and parts and all sorts of things. And even if you're providing a service, there's kind of broader impacts to the economy. But actually, in terms of venture capital and the kinds of businesses that you want to build, most of them, in my experience, actually the UK is not a big enough market on its own. They're almost born with an international feel and flavor to them. So even though they might be located here, they're selling all over the world. And again, if you think about some of the US success stories that were created, Meta and Google and Apple and so on, again, they're successful not just in their domestic markets. And again, if you think about the economic circumstances in which some of those companies were created, it's not always the case that successful companies are created right at the peak of the market. Actually, there's quite a lot of innovation and new company formation that happens at moments like this when the economy isn't necessarily doing very well, because there's talent around, so people perhaps move on from existing roles and start something new, because people are looking to save costs. There's a real appetite for things that can be better, faster, and cheaper, which is what typically new kind of disruptive startups are. And from a kind of time diversification perspective as well, as an investor, these tend to be times where there's less money around. The kind of the market dynamics and pricing tend not always, but tend to reflect that. So actually, again, it's when you've got a really long time horizon, you don't have to worry so much about the ups and downs and the cycles so much. You can think more generally about.
Well, I think that's really interesting, and I wonder also if it maybe focuses you on different sectors, because tariffs are very much focused on goods. It's about people who are importing and exporting goods from different markets around the world. And I know that we all seem to be in love with the manufacturing sector, but the reality is that the UK, like the US, its biggest successes is actually in the service sector. So does this kind of environment make you think, well, yes, I'm going to focus on investing in service-led companies because they are immune to all of this tariff negotiation? Obviously, they'll be affected by the strength of the economy, but we can insulate in a way by focusing on services.
Well, again, one of the strengths of the UK is it's a largely service economy, not exclusively, but actually we're very good at things like financial services and pharmaceuticals and areas like that. So even though, but having said that, even though this is largely focused on goods, as I mentioned earlier on, even if you're providing services, there are still impacts from tariffs in terms of having to buy components and parts and other aspects as well. I mean, I think from a personal point of view, I live in Scunthorpe, so I've been living with the impact of manufacturing in our local economy for a long time. And recent announcements, you can see again, it's this ripple effect of what happens when a local business is impacted, and the impact that has on things like orders for extensions and builders and all that kind of stuff. So again, even though we're a service economy, there's still this kind of broader kind of impact economically. But in the story of the week, if you go back to those businesses, a third of businesses saying they won't be impacted, and that might be a surprise, and the fact that actually we are a service economy might be one of the reasons for that. And indeed, when I think about dislocations, it's been a very busy 10 years, hasn't it, for disruption, in terms of we've had Brexit, we've had COVID, and I think tariffs as part of
Trump too,
Well, we've had. I think there's been a kind of backdrop of geopolitical noise, whatever you want to call it, building for some time, and tariffs are the kind of latest installment of that. So, in terms of dealing with dislocation, actually, we've got quite a lot of experience of that in the recent past. And smaller companies can be quite adaptable and nimble and make changes that perhaps larger companies can't.
Yeah. So we've talked a lot about venture capital and that. Let's bring the elephant in the room back into the centre of the room and talk about that, which is obviously we've had the UK government talk a lot about productive finance and wanting to get pension schemes involved in investing and involved in funding this sector and infrastructure as well. How can pension schemes help? What problem can they solve? Is there sectors that really would do so much better if we had that long-term funding behind them?
Yeah, so back to the kind of, I'll come to the specific in a minute, but back to that kind of more general point around venture. There's this, how do we marshal more of our capital to these kinds of companies? And the answer in the States appears to be that they've done a better job of persuading institutional investors, including pension funds, to invest in their venture capital funds. So if you look at in the States where venture capital funding comes from, about 72% of the commitments for venture capital funds come from pension funds. In the UK, that figure is about 10%. So if we really want to fund better the companies that are starting to break through, that in turn requires us to better fund the venture capital industry. And in the US, where they appear to be better at this than we are, the answer, when you trace the money all the way back up to the top of the stack, appears to be pension funds. And they had reforms in the 1970s and so on that kind of helped get the ball rolling. So some of this is actually just about time, and you've got to start somewhere. And the kind of miracle of compound interest, as Einstein called it, that's you start slowly, but it increments over time. So that appears to be quite a big missing piece of the puzzle in the UK. It's that institutional participation in the asset class. And then a bit like us, we started in venture nearly 20 years ago, doing 1 or 2 deals a year. And now, we invest at a much bigger run rate than that. We also do co-investments and invest directly into companies and so on. And that's a journey that we've been on. And again, when you look to other countries like Canada, Australia, their pension funds have been on a similar journey when it comes to these parts of private markets, which is starting as funds and then moving on to be direct investors as well. So to me, that's the role they can play, and the journey that I'm kind of seeing. I mean, in terms of what's in it for them and why they would want to do it, I mean, I think I've kind of alluded a little bit to that. in my answers already, which is, in theory anyway, this is a long-term asset class that's aligned very well with the long-term horizons of pension funds. And when you think about the economy of tomorrow, when you think about how these kinds of investments can improve all of our lives and help solve climate change and help cure diseases and help improve productivity, help drive growth and prosperity and all that kind of stuff. There's a sort of potential returns piece. But there's also a kind of broader societal impact to it as well.
You touched on improving, curing disease. Let's talk a bit about biotech and pharma. That's something you and I have talked about before.
Yeah.
I mean, we obviously have a very strong biotech and pharmaceutical sector in the UK. We have a lot of good ideas that come out of universities, but perhaps surprisingly, that industry struggles to find finance. I mean, on one respect, it's not surprising because it's very risky. Developing new drugs is a very risky endeavor with only sort of a 10% chance at the very, very early stage. So what are the issues there, and how can we help to solve that and make that really, really sing, so to speak?
Yeah, and I mean, I'll come back to that perception of it being risky in a minute, which I think is in and of itself is an incredibly interesting question. But yes, it's like a poster child, life sciences, of the rest of UK innovation. We're fantastic at the innovation. We're really good at starting, and then when you look at how we scale things up, that's where we seem to not be as strong, particularly as the US is. Some of that actually comes back to having the specialist investors that understand life sciences. I mean, here at BBB, we have a team, and it's got some PhDs in it and things like that, because you have to really understand the science of this and how that works. And in terms of how you get deals done and make all of this happen, that's particularly an issue in terms of having enough lead investors. So not just enough investors, but enough lead investors who can pull together around and lead the due diligence and do all that kind of stuff. And so one of the programs we have at the bank is called the Life Sciences Investment Program, which seeks to bring more capital into the market at this later kind of scale-up phase to support UK companies to tackle exactly that issue. So yeah, capital is part of it. In terms of other things, I mean, clearly it's a very technical discipline. So you need good access to people. You need good access to customers. Actually, the UK has a really thriving pharmaceutical industry generally, which is incredibly helpful. But that piece about risk is really interesting because, of course, the company doesn't necessarily have to go all the way to launch its drug for it to be a financial success. There are other ways for that to happen. And there are lots of ways that risk is managed, such as, for example, tranching. The way that capital is advanced tends to be tranched on kind of scientific type of milestones. Life sciences companies tend to be pretty good at finding industry partners to partner with and share risks and so on. And then even before you kind of get to an approved drug, there are very often acquisitions of companies and IP and so on. So again, it's one of the challenges we sometimes have, I think, with these sorts of companies is it's not that they're not risky, but it's really understanding what the risk profile actually is. And of course, there's a very different risk profile as between a single company, a portfolio of companies, and then a portfolio of these sorts of companies. So again, how you defray the idiosyncratic risk perhaps of individual diseases or different approaches and things like that is an altogether very different thing. So yeah, we've been investing in life sciences for quite some time at the bank and have a number of initiatives designed actually to ensure the UK can fulfill more of its potential here.
Yeah, I mean, what you touched on as an ex-investment analyst of the pharmaceutical sector is how things have really changed over the last quarter of a century now, and how it's kind of a bit like the venture capital system. There's kind of different bits of the industry that do different parts of the journey, isn't there? Where we're now pharmaceutical companies, largely with the possibly exception of Novo Nordisk and Eli Lilly having invented Ozempic and Mounjaro, have kind of stepped out of the innovation phase, and they're very reliant on biotech, small biotech. And as you say, then venture capital kind of steps in and releases money according to scientific milestones, and then And it used to be, you would go straight to IPO, but of course that doesn't happen so much anymore. And you just get often a new company with a new idea will then just get acquired by a larger pharmaceutical company that really no longer specializes in the innovation, but what they really specialize in is clinical trials, marketing, and sales. They can do all of that very resource intensive part of the journey, and they're very specialist at it. That's a fair sort of summation of the journey, isn't it?
Yeah, and I think what's also changing as part of that is AI and how it allows drugs to be discovered in the first place, and actually allows potentially for the creation of platforms more broadly than just a single drug or a couple of drugs. So yeah, I don't have a science qualification other than my combined science GCSE, but I've spent a lot of time in the last 10 years reading about life sciences because it's been a big part of our portfolio for a long time now.
So sort of as we move towards the end of this wonderful podcast, I think the industry, if we go back to the pensions industry, they've heard quite a lot about the why of why they should invest. And I think they're keen to, for those that, and I'm not going to go into the whys and wherefores of whether we should or shouldn't invest in venture capital, that's best left for another forum. But people are becoming increasingly interested in the how. How do we actually do this? Because there's one thing to talk about the why, it's another thing to talk about the how. How are you seeing things develop? Is it just about people developing LTAFs? Is it about people developing internal expertise on venture capital or developing relationships with venture capitalists? Are we seeing different ways of operating for different pools of pension money or institutional money, whether it's a master trust or maybe a contracted out scheme or the LGPS or an insurer even? How are you seeing that develop from your perspective?
Yeah, I think it's developing in lots of different ways for lots of different investors. Some of it is because the nature of the capital requires a certain approach, and some of it is because the nature of the institution means they're just in a different place in terms of their journey. So there are and have been pension funds who've participated in venture and private markets before, and for them this is really an extension of potentially what they were doing before or complementary to it. There are some organizations for which venture perhaps doesn't make any sense at all because of the profile of their liabilities and so on. So to your point, it feels like that thinking's been done and there's been a good sense of where does this make sense, and we're turning now to how. And the how is really at the foothills of the journey. I mean, LTAFs, I think, seem to be shaping up as a big part of the solution, but they're 2.5 if that years old and very young, and how do they work? And there's not too many of them around, certainly focused on venture specifically, but more are being approved. I keep a kind of track of the list of LTAFs, but that seems to be a vehicle that has some momentum. In terms of whether it makes sense for people to do this themselves or partner or whatever, again, I think those things are not necessarily mutually exclusive. Again, with us, it's taken us nearly 20 years to get here. We did a mixture of both in the beginning. We invested in funds, we did some fund of funds, and then more recently we became a direct investor. So I'm sure various organizations will go on their journey, but the most important thing we did was get started, and I think that's the question: is what's the right way to get started and kind of build exposure over time, and people are working through currently exactly the right way for them in the context of where their money comes from and what is and isn't allowed, and the maturity profiles of it as well. And
also something we talked about with Veronica is, how much of your portfolio you're going to assign to this to make it worth your while to basically learn about a whole new asset class too. So, yeah, I mean, this might be somewhere between 2 to 5%. And realistically, it's not going to be, I mean, obviously you've mentioned the liability, so we could put it to one side, closed private sector DB schemes, and insurers in a way, they kind of have this weird thing where they're making warm noises about it, but given that everything they do is fixed income, I'm not quite sure how that fits. So we are looking at those schemes which are open and going to be building wealth for decades to come, and that is LGPS and DC schemes. And you could see that kind of from an investment perspective makes sense, but then you need to get into how much resource do I dedicate to this and how much of my portfolio do I allocate? Is it between 2 to 5%? Are you having interesting conversations around that at the moment?
Yeah, and I think that the most interesting part of that is actually how quickly the 2 to 5% grows, because the overall is growing, right? So actually there's a lot of money that will be coming into to these schemes. And if I think about the difference between me and my parents probably didn't pay that much attention at all to their pension because it was all DB, and the only thing you had to do was pay into it. And now you have this working lifetime of and beyond of worrying about where your pension is and what's in it and all the rest of it. So that dynamic, I think, and everything that brings with it is a real change, including potentially, by the way, the option to really start firing up people's inspiration about what their money is being used for. Whenever I talk at any great length about what you're already invested in as a taxpayer through us and our portfolio, you get to tell these amazing stories about these great companies. And so there's that element of it as well, which we've never really had before as an industry. In terms of sharing with people what their pension's been used for and where their money's gone and so on.
Well, I think that's a great place to leave the first podcast of the third series. Thank you so much, Ian, for being the guest on the show. It's been fantastic talking to you. Thank you for your insights. A delight to sort of talk a bit more about business rather than just pensions all the time. Listeners, I hope you enjoyed the show. And if you want to make sure you never miss a future episode, then hit the subscribe button. Thank you for listening.